Good Saturday morning to you, and welcome to On the Mark, along with Mark Papa. I'm Gary Byron. Mark is from Financial Resources Group. They're located in Glastonbury. You can find them online at www.frplan.com. That's F as in Frank, rplan.com. He's also got his own YouTube channel. This is pretty cool. There's a link right on frplan.com, or you can just go to YouTube and type in Mark Papa 5207. Mark spells his name MarkPappa 5207. He's got everything that we discuss here on these shows every week, as well as a lot of other information and tidbits, and certainly things that'll help you build your portfolio, plan your retirement, and so on and so forth. If you'd like to schedule a no-obligation consultation, or maybe you just have a quick question to ask him, don't forget, he's got that 21-point checkup, and it'll garner you a $100 gift card. It's a win-win situation for you, it sounds like. Write this phone number down. Do more than that. Call it. You can call it at the end of today's show. You can call it Monday. You can call it during the week. Just make sure you call it. 860-657-8380. Again, 860-657-8380. And if you missed any of those points of contact, you can just wait. I'm going to mention at least a couple of more times before the show is over. Now, financial planning and investment advisory services are offered through Financial Resources Group, LLC, a registered investment advisor. This is not an offer to buy or sell securities. Please consult with a licensed investment professional before making any decisions. Mark, good morning. Great to see you.
Hey, good morning, Gary. How are you?
Not too shabby. How was your week?
Well, just another week.
Just another week.
Just another week.
Is that good or bad? Because you're always, I'm telling you, so you're a busy guy.
Yeah, no, it's a good busy, though.
You need a vacation, brother.
It's a good busy, yes. I definitely do. Just to get away for a little bit, even for 3, 4, 5 days would not be a bad thing for me, just to decompress, lock my phone down. But no, things are good. Things are moving right along, and that also makes me happy too. So.
I'm so happy to hear that. I really am. I mean, I know that you are very highly regarded, in this area, in this field, and I know that because I hear it from people. I know people who have met with you, and they walk away saying, Gary, I wish I had met this guy earlier in my life. And you explain, I don't want to, I'm going to use a term. I don't mean this in a derogatory way. I mean it actually in the best way possible. But you dumb it down for people. You give it to them straight. You don't talk over their head trying to boast yourself and make you sound, so important. Some people use jargon that, unless you work in the field, nobody knows it. You explain it to people on a regular level. I've heard nothing but great things with people who sit down and talk with you. So
thank you.
Your success is well earned, my friend.
Yeah, thank you very much. And I think it's most importantly through that full checklist review that I do with people. And oftentimes I get them to tell me.
See, that's the key here, isn't it?
Yeah.
You can't do this without an individual, customized 21-point checklist.
Well, it makes a lot of sense. Now, we're talking about the $100 gift card that you get, and that's just to take care of your time, just to get you to bring in your documents. I mean, we understand getting a copy of your home insurance isn't the easiest thing to do, or digging up, that old power of attorney out of your lockbox in the closet and blowing.
Some people don't even have that.
Yeah, and some people don't even have that, blowing the dust off of that, and coming in and having us scrub through, your banks, your different statements and your different investment accounts that you have. Is a pain in the neck. So as a result, we'll compensate you $100 if you come in for the full checklist. You can get that $100 gift card. No questions asked, no obligation. If you decide not to do business with me and you're just fishing for information or whatever the case is, it's still yours. But most people...
I can't imagine they would just come in for $100. I mean, they can. Sounds like it. No questions asked. But they're going to gain more of your knowledge than whatever a $100 gift card could.
I'll explain. And I'm not saying that we even deal with a lot of $250,000 households anymore, just because the market's, most people who used to be $250,000 are now 500,000, or most 500,000s are now millions. It's because time goes on. And what you used to be able to work with, I really like to work with folks with anywhere between 500 and 2 million. Is probably the sweet spot in terms of
500,000 up to 2 million
total assets. That's typically where we are. But you know what? Because of this checklist, even above the $3, $5, $10 million people, and you pack in my tax knowledge, we can really make a huge impact on those folks, because I've learned that a lot of their accounts are, in stock accounts, and they get traded a lot, and they get passed on a lot of different funky things. But I can just say, for your typical $250,000 household, the $250,000 401k, Gary, on average, what we find in benefits that they're owed or not aware of are $3,291. And that's over 50,000 meetings that were recorded. So $3,291 in benefits that they're owed. Now, if we find those benefits and help them recapture those benefits, do they have to work for that money, Gary? Or do they get to just put that money back in their pocket? If I found $3,291,
I'm keeping it.
You're keeping it, right? So
I am. I can't speak for anybody else, but I am.
Take that number, okay, and you multiply that times 10 years that you didn't even know. That's $32,000 in benefits you were left on the table. Now, what kind of, could you go to Disney on $32,000? Could you buy a new car with $32,000? You can do that with $32,000,
and then some.
Right. So would you rather, again, fold your, not come see me and not know? I can tell you that's the average. Sometimes we find less. Oftentimes we find significantly more. So let me dig into the hood for you. And not just there to talk about money. We want to make sure you have a working power of attorney. We want to make sure you have the language for your power of attorney that actually works with Social Security. Because right now your power of attorney does not work with Social Security. You can Google that. Making sure you have your medical power of attorney on a card that can follow you all over the country in case you need to get in an accident. So anyway, but Gary, I know we were going to talk about this. I wanted to just give a little bit stronger plug.
It's good to know.
Kind of recap the things that home insurance too. Remember I mentioned before, they're hollowing out policies, premiums are going up, and you might get caught off guard on your home insurance. So let's say, for example, I find something in your policy, or we help you find something that would have normally paid $10,000 or $20,000, and you had to pay a portion of that, a big portion of that out of your pocket. We're not even talking about the $5,000 or $10,000 or $20,000 we're saving there. That's not even included in this $3,291. So you can only imagine what's out there. We just want to make sure, when we sit down with folks, that we're thoroughly going through every detail of their financial life, whether it has to do with an investment or a non-investment. Insurance is non-investment, but if you're going to get paid back that money to cover a claim, I mean, in and of itself, who do you want them to pay? The insurance company, or do you want to pull that out of your brokerage account?
You're right. Yeah.
So we've heard those nightmare stories, and that we've helped people fix. So
last week we spoke a lot about the equity side of your portfolio.
Yes.
And to rave reviews, by the way, I figured we'd continue a little bit with that.
Thank you.
And maybe we can focus on your fixed income strategy. Maybe you can explain how one's fixed income portfolio is designed over at Financial Resources Group, and what principles guide it to construction? How do you construct this?
Good point, and shame on me, because you just mentioned jargon. I should have brought up that fixed income is just a fancy schmancy term for bonds. Okay?
Yeah, right. So we're talking about bonds today.
And there's that movie, remember, Gentlemen Prefer Blondes?
Oh, sure, yeah.
I saw this really cool hat. I think it was one of the big banks that said "Gentlemen prefer bonds." So,
Barry bonds, or
no, we're talking about income-bearing and interest-bearing bonds. So this, obviously for the uber wealthy, they don't need to take any more risk, so they like to have a big, a lot of their money in safe money in bonds and things of that nature. But as we know, bonds are not all that safe. If you go back to when I did my show,
because they're high risk.
The 30-year Treasury lost almost over 30% in 2022. So we have to be careful of the kind of bonds we own. And then when we build our bond portfolios, what type of bonds are we going to be using? And are those bonds going to be safe for our investors to, again, stomach the volatility of their... Because typically, the old saying is when stocks go down, bonds go up. Back in 2022, bonds were at all-time highs. Stocks were at all-time high valuations. When the Fed raised rates, they both lost money. So 60-40 did not work at all. It was dead. Now that rates are elevated and people are still, unfortunately, whether you know it or not, you're still recovering your bond portfolio. Mm-hmm. Most of you people are, especially if you have a mutual fund that has, 1 to 5s, 1 to 3s, 3 to 5 year maturities. And now when I talk about maturity, what I'm saying is at the end of maturity, when you have a bond, let's say I have a 5-year bond, I buy it today, I put in my $10,000. At the end of 10 years, I collect my interest, and I'm going to get my money back at the end of 5 years. Okay. So we like those bonds that tend to be shorter term simply because they're still paying very good yields and there's less risk. Most people can probably wait 3 years for the maturity to get their money back. They can wait 5 years to get their money back. Where you have a problem is in 10, 20, or 30-year bonds. Everyone says, I'm going to do a bond ladder and I'm going to retire. It's going to be great. Well, unfortunately, if you need to tap your portfolio and you're going to have to tap into your 2 to 3 or 5-year bonds, now you're eating up current income. But if you have to get your 20 or 30-year bonds and those are down in value, just like when the stock market was down, you just locked in a big loss. So when we build a bond portfolio, not only are we using just treasuries, we're using, similar to the equities, all sorts of different types of bonds. Okay. So, for example, and again, we like to stay less than 5 years on our average maturity. Now, you can go a little bit longer than that. And in the instance where we do go longer, we do have exposure to what's called the Barclays Ag. We have a little bit different version of that. That's the AGGY. And we like that because that was sort of recalibrated to be a little bit less risky. And then we also marry that with another type of similar bond fund, but it has an interest rate hedge on it. So you have to understand what happens. Remember when I mentioned when interest rates go down, bond values go up. Longer maturity bonds typically go up more. They're more volatile, but more than short-term maturity bonds when interest rates go up or down. Okay, so we want to make sure that if rates get cut, that we're making money on the long end, but we don't want to do it with the risk. Whereas,
would this go for government bonds as well?
Yeah, mostly. Yeah, I would go for government bonds. We don't like to have tons of exposure to the long end of the curve. If when you get a clear path that the Fed's gonna cut rates, we know that they're most likely going to cut in the next 3 or 4 meetings, that's the time to maybe take your exposure and extend it beyond that 5 years into 6s, 7s, 10s, maybe 15s, because those bonds will make money on the back end. Now, ultimately, should we really be in bonds? We're not bond traders, but you still get some capital appreciation when rates come down because those longer maturity bonds go up in value when rates go down. And that's what was happening for many, many years. And bond values were inflated, the underlying bonds were inflated. The yields were terrible. Now we have pretty good yields, and everyone's pretty happy. They're getting more current income.
Sounds like you favor more like shorter term maturity bonds at this stage. So how does that fit into your strategy, especially with risks like inflations and these tariffs talks that we've been hearing about?
Well, it's just a safer place to be right now. Let's also add, we have $36 trillion in debt. And I don't know about you, but if someone had $36 trillion in debt, do I really want to own a ton of 30-year treasuries? This is a problem we're going to have long into the future if we don't get that under control. I'm looking at something that could potentially go bankrupt, and I'm on the hook for 30 years. What happens between now and 30 years? Who
the hell knows? I'll be around in 30 years.
Who knows if I'll even be around in 30 years? But it's a little scary knowing that, our credit rating and everything else, if we don't get our spending under control, we are in some deep trouble. And I don't want to be on the hook 30 years for anything for that matter.
I can't say I blame you. Speaking of risks, you've highlighted the Wisdom Tree interest rate hedge, the U.S. Aggregate Bond Fund, the AGZD, to hedge interest rate risk away from a broad bond index like Bloomberg U.S., the Bloomberg U.S. Aggregate Bond Index, the AGG. Why this approach, especially with the Fed potentially delaying rate cuts?
Well, we like this because we don't have to worry so much about the volatility of interest rates because the AG does have a maturity that has long exposure and short exposure, so it's a blend. But the other problem fundamentally with the AG was, just like when I mentioned how 10 stocks controlled the S&P 500, 30%, the AG is designed so that the biggest debtors get the biggest slice of the pie there. So do I really want to be pouring all my money into an index of the biggest debtors? Or do I want to have my bets spread out a little more? AGGZ does that, and AG that also they will also hedge your interest rate risk so that if rates go up rates go up, you're not going to get hammered so bad. In fact, we barely got hammered at all in 2022. And I don't want to quote numbers, but they were really, really good numbers because we had the interest rate hedge.
But it's not 2022 anymore.
No, it's not 2022. However, where we are today, we're still not fully convinced that the Fed is going to cut rates. In fact, with the tariff talk and everything else, they may want to pause. They may want to wait and see. They may want to see more evidence the economy is slowing. They want to see more evidence that inflation is slowing, that tariffs don't cause inflation. So there's a lot of uncertainty there. So I'm not ready to take my interest rate hedge off because it doesn't cost me that much. And why not keep the, why go? I'm not going to go risk on right now in a time of uncertainty. That's just bad money management in my position. We're not a hedge fund. So if it was my job to bet the directionals of interest rates and I worked in a big bank or, I was a hedge fund, we can do that. But I'm more comfortable knowing that we're protected against interest rate fluctuation and volatility. Okay, so that's more of the thing. And then on top of that, owning different types of bonds. So maybe you...
No, go ahead. No. I didn't want to know.
On top of that, owning different types of bonds. So we have, for example, you'll have high-yield bonds, high-yield corporate bonds, which are paying very, very healthy interest rates or healthy yields, healthy coupons, whatever you want to call them. But, the type of bonds that you buy, again, you don't just buy the index because, again, these are high-yield bonds. These are not, these are below corporate, below grade technically. Right. These are people who have to borrow with not the best credit scores, or they're doing something major with buying a company, whatever the case may be. But their credit rating's not all that good. They're trying to rebuild the company, whatever. But they're still solvent, meaning we don't see a lot of defaults in high yield bonds at this stage of the game. So what we do is we also make sure, if we're buying the high yield bonds, that we're buying the best of the worst. Okay, so we're buying higher quality bonds, more quality factors, ones that are less likely to default. But not so much just buying HYG, which is the index again. You're just buying an index. You're not going to get the same quality or value that you would as if you buy something that's focused on quality or value. And so that's why we do that. We're willing to pay a little more in our portfolio to make sure that we have that default risk is a little bit lower.
That makes sense.
In addition to that, we'll look at things like mortgage-backed securities. Now, mortgage-backed securities is another area that yielding somewhere around 4 and 5%, and these are backed by government-sponsored entities like your Fannie Mae's, Freddie Mac's, and they tend to have low credit risk. Now, the unfortunate part is what comes with a mortgage-backed security on the newly issued mortgages is prepayment risk. We haven't had a lot of prepayment risk. It's because a lot of people who issued their mortgages down at, we talked about it before, 2.75%, 3%, 3.25%. They're in no hurry. And it's a long way away before they're ever going to be able to refinance at a lower rate, probably never. So they're going to own those forever. However, if you took out a 7%, 6% mortgage recently and rates dropped to 4%, your mortgage broker is going to be calling you. Okay, you're going to refinance, and that's what you called on that refinance. You have that prepayment risk, people paying off the mortgage early or whatever. You don't want that. Right. You don't want to have that. So,
you are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark Papa has got a business in Glastonbury, Financial Resources Group. You can find them online at www.frplan.com. And write this phone number down. You're going to need it. 860-657-8380. I'll repeat both of those points of contact. I'll even toss in a free YouTube channel for you that Mark has more towards the end of the show. Mark, I mean, look, I'm listening to you, and that's certainly a strategic way to manage, I don't know, for lack of a better term, we'll call it uncertainty. So I'm hoping maybe you can just detail the various bond types in your fixed income portfolio, such as like high yield or mortgage-backed securities, collateralized loan obligations, excluding commercial office, let's say, short-term treasuries, specialty high yield municipal bonds for non-qualified accounts, any of these.
Absolutely.
Okay.
Well, I'll go down the list. The collateralized loan obligations, again, are, we're looking for higher yields than what the Treasury's paying.
Sure.
So when you blend the yield together and you do it the correct way, and, you really look at your Morningstar over and over and you hammer this thing out, you're on there with the anvil, smacking the sword, trying to make the best sword, ultimately, you're going to look at probably about a 5.5 overall yield in the portfolio. Some things are going to go, 6 or 7 or 8%. Other things are going to be paying a little bit less because it's higher quality. The higher the quality, the bigger the allocation. The lower the quality, the smaller the allocation. Very simple. Higher risk, less allocation. Less risk, bigger allocation. Do you see how that works? You're blending the risk. You're spreading your risk within the portfolio. But also in the collateralized loan obligations, or they're backed by either leveraged loans or, a lot of times they benefit from floating rates. And we also have a floating rate means when interest rates go up, you can actually reset the rate that your borrower has to pay and the rate has to go up. That's no different than a variable rate. If interest rates go down, well, now then they could reset at a lower rate. So sometimes people with less quality credit will go for a floating rate for whatever reason, or whoever's willing to lend the money will give it to them at a floating rate just for whatever reason, better for that customer, better for their situation. But they pay very, very nice yields. So when rates go up, you don't get hit that badly. Although they do, the underlying, unfortunately, still does when people sell their bond portfolios. Even the things that are supposed to be benefiting from rising rates tend to get sold too, because people just throw the baby out with the bathwater. Right. Unfortunately. So those are often, backed by. Those are actually something that we, tend to gravitate towards too. Again, not huge positions, but because we're diversified, floating rate or CLOs, collateralized loan obligations, short-term treasuries. I mean, we've getting really awesome rates on that too. So they're paying somewhere between 4 and 5%. Those are treasuries that sometimes even 1 to 3 they mature. I've even seen 3-month treasuries pay decent yields. So these are for
really.
So you have to have your short bucket, and that's for money that you need to grab. So if I need to grab money, or if someone says, "Oh, I've got my grandma gave me $80,000, and but I want to buy a house in 6 months. Where do I park my money? Can I put it in a CD?" I said, well, what happens if you need to buy the house that you want in 3 months and it matures in 6? And we'll throw that in a money market, or you can throw in the 3 month to 1 year fully liquid. You can sell it the next day, cash out, get your money, and go make your down payment. So those are ultra safe investments. So we want to make sure that we have those as well, that we're not just stuck in. We're not just stuck in same kind of bonds or the same type of portfolio. Okay, so does that make sense?
Sure.
Yeah. So that's really, I would say, it. But I think the main thing is to make sure when we make these portfolios that we're allocating correctly. So when I mean allocating correctly, again, the less risk the bonds have, the greater the piece of the pie. So we'll probably have about 6 to 7 positions in our.
But I thought the higher risk, you make more money on higher risk, and you make fewer dollars with lower risk.
Right, and that's why we put less. You make more money in something that has higher risk, so you put less in the high risk and more in the less risk.
Right. Okay.
And you balance things out. In other cases too, we've used what's called an interval fund, and the interval fund is all their best fixed income ideas. It gives the manager tons of flexibility. So inside there, they'll have maybe commercial-backed real estate, non-office. I won't touch that with a 10-foot pole. They may have warehouses. They may have other things that they're using as collateral to lend against. They'll have mortgage backs. They'll have collateralized loan. It's just a package of bonds, different kinds of bonds that they underwrite, or they underwrite or they do tremendous amounts of research on. That pay an excellent yield. The downside to that is you can only trade it once every 3 months. Oh, okay. So usually the better the yield, the better they're willing to offer you, the less they give you. And what I love about this is there's a municipal version of that we just started utilizing. I won't name names, but the municipal version is paying somewhere in the neighborhood of 6%. Oh. And that's federally tax-free.
Very nice.
So, again, can only be traded once every 3 months, and they're very specialized deals. It might be a public-private partnership, or maybe a municipality wants to build a stadium like the Yard Goats, and they have to issue bonds to get them off the grounds, But they pay a higher yield because they're higher risk. But it's a well-diversified fund for people that have been doing it 100 years company history. So, but there's a lot of awesome opportunity. But making that bond portfolio marrying with the stock portfolio, your equity and your bonds. That's what that's how you want to blend things together to stay in your lane and not get knocked out of your retirement.
Because I'm running out of time, and let's talk about it just takes 60 seconds. Talk about the 21-point checkup and the $100 gift card that people can earn just from coming in and meeting and doing this 21-point checkup.
Okay, well, in simple terms, the whole idea is to help you discover things that you were never shown or you weren't aware of. We're there to find benefits that you're owed that you weren't aware of. We're looking for hidden fees, insidious costs, turnover costs, trading costs, things that have not been revealed to you that are eating away at the foundation of your retirement that you have no idea about. So it's no different than if I said I was going to give you a $100 gift card to come check your house for termites. You think you don't have termites. You may not have termites. But you know what? If I find those termites, or, before they become a huge problem, right, you can call the exterminator, get it taken care of. But I would say that we want to make sure that we're working with people to help them make the best possible retirement, the best possible situation for their retirement. They're not getting caught off guard with unpaid insurance claims. They're not getting caught off guard with their bank power of attorney not working with their bank. You're not getting caught off guard with not having umbrella liability insurance. So, again, those things are a heck of a lot more valuable than my $100 gift card, but I will compensate you if you're willing to come in and get that done.
Time is precious, it's valuable, and it's very nice of you, generous of you. I really appreciate you unpacking your fixed income strategy and addressing these macroeconomic risks. Your approach, Mark, I got to tell you, it clearly prioritizes resilience and adaptability for your clients. I look forward to next week's show. I hope you are as well. Folks, if you missed any of this, head on over to Mark Papa's YouTube channel. When you get to YouTube, you simply type into the search field, Mark Papa 5207, MARK PAPPA 5207. And if you're on his website, there's a link to YouTube, his YouTube channel, right on his website, which is www.frplan. That's F as in Frank, rplan.com. You call him, schedule. You want to do this 21-point checkup and get your $100 gift card. Call to make an appointment today, 860-657-8380. Once again, it's 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Mark Papa from Financial Resources Group. Until next weekend, have a good one, everybody. So long.